over the last 10 years with technology, with crowdfunding, syndications have blown up. And a lot of people now want to invest in real estate where probably 10, 15 years ago, that wasn't even an option.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steve, we're going to be talking about a little bit different topic today, reviews. We like reviews.
So we really need reviews.
Well, it's not a different topic. I mean, we ask every week.
Yeah, we ask every week. But it really helps us get great guests because when we talk to guests about coming on the show, they say, well, who listens to it? And they go on and they check out the reviews. And if we have some decent reviews, it helps us attract better guests and we all benefit from that.
You know, people have asked us about YouTube. They said, when are you guys going to have a YouTube channel? Well, we actually do have a YouTube channel. And, when folks, they point out one, it says the Invest Florida Show. That's actually not our channel. So there's no episodes, there's no videos on this channel. It's true. There's only two. The actual one that you can find, if you want to look it up in the YouTube search, is Invest Florida Real Estate, a real estate podcast. That's the one where all of our audio content is. But Steven, audio.
Well, first of all, just getting back to YouTube, you all are really the benefit of YouTube because at YouTube, and ours is only audio, you don't have to look at Eric, you can just listen to him. And it just makes the whole thing a lot more appealing and you would probably learn a lot more.
It's certainly less distressing, right?
Yes, much less distressing.
It's a situation where Steve and I both have faces for radio. We've made this comment before, but it is true. And we're probably never going to go over to some sort of video, but we do have all the content on YouTube. And I wanted to point out Mendel Tiefenbrunn, that he says, love this show. And it's important because whether you're leaving comments on YouTube or you're leaving comments on Stitcher or iTunes or wherever else, it does help us because we don't know where our potential guests are reviewing us and doing due diligence, whether they're going to try to invest time. So we really appreciate Mendel leaving that comment there. We don't get a lot of traffic on our YouTube channel because it isn't a video, it is audio. But, heck, we had almost 1,000 views going back to one of our Lawfare podcasts. I believe that was Rob Walton in Adverse Possession. That's a lot. I mean, he actually has more YouTube hits than he does on the Stitcher channel, which is a lot more distributed venue, right? So it's just interesting to see people are still listening and they're paying attention on YouTube, even though there's not video content there.
But anyway, bottom line, guys, please give us reviews so we can all get the benefit.
Yep, absolutely. And Steven, today we've got a multifamily syndicator. So unless you've got something else, let's go ahead and roll in with our guest.
Let's do it. Sam Bates is the founder and CEO of Bates Capital Group. Sam started his real estate journey in 2009 and has been involved in the acquisition, reposition, disposition, and asset management of over $150 million in assets under management. His portfolio currently consists of 924 units in Texas and the Southeast, and Sam and his partners have roughly another 550 units in the pipeline. Sam had spent a decade in corporate America working in various consulting, finance, and accounting positions, and he woke up one day and realized that a W-2 job was not going to satisfy his desires. So he started investing in real estate and quickly realized how powerful real estate is and decided this is where he wanted to go. Sam has a Bachelor of Science from Texas A&M University and also an MS in Personal Financial Planning and an MBA from Texas Tech University. Sam, welcome to the Invest Florida Show.
Stephen, thank you for having me on, and Eric as well. And I look forward to sharing my knowledge and information with your viewers, and hopefully it can add value to you and your viewers as well.
No, we appreciate it, Sam. Why don't you start at the beginning? Tell us about, well, I'm not talking about from birth. If we started with Stephen from birth, this would take up the entire show. We're not talking about from birth. We're talking about just from the moment that you decided that commercial real estate, multifamily in particular, was what the direction you're going to go with your professional career.
That was a good question. And I almost went and got my master's in real estate. I was a finance undergrad, and I've always loved numbers and just how markets work. I started investing not in real estate, but just in the market when I was 11 with the help of my grandfather. And really in grad school, I read a book that was Rich Dad Poor Dad. I think most people that have invested in real estate have read it, and it just kind of changed my paradigm shift. And then after I graduated, I quickly was at a job that I was paid well. I was surrounded by a lot of smart and a lot of great people. And I consulted for Fortune 100 and Fortune 500 companies, but it just wasn't satisfying. And it wasn't something that I wanted to do for 30 or 40 years. And I kept going back to real estate, and I started to research and figure out exactly what all avenues you can take. And in 2008 or so, that I made the decision to start investing, and it took me a little while to learn and feel comfortable investing because it is such a big investment. And I started off as a limited partner in several deals, and I did single family for 4 or 5 years. And I realized that you couldn't scale it and you couldn't grow single family like you could multifamily. So then I pivoted a little bit, and in 2016 is when I started to become a GP on deals. And from 16 till now, I've been a GP on 13 deals, 10 of them being multifamily, and amount of assets under management and just the number of doors have come over the last 5 years.
So you started an interesting period starting in 2008. I mean, that was when the world collapsed, and I guess that was a great place to start from.
Yes, it was. And honestly, from early on, I thought the stock market was the best way to go. And I worked at UBS as an investment analyst, putting client portfolios together. And then when the market did crash, I knew I wanted to find other avenues to invest instead of stocks. And I know in 2008, the real estate market also crashed in a lot of parts of the country. But for some reason, it just kept pulling me there. And I felt like the more research I did, the more I realized it's much more market and even sub-market specific than just from a national or global perspective. And I have no control over a stock in Coca-Cola or whatever stock it is, but I can have a huge impact on one piece of land, one single family, one multifamily asset that it might not be impacted as dramatically as a stock portfolio would be.
Yeah, that's an awesome pivot, and a lot of people seem to come out of the tech world and finance world and go into real estate. So, tell us about about where you started and what type of a deal it was.
The first deal we did, I'd actually been looking for acquisitions for about 2 years, and I was still in my 20s, and at that time, we thought the market might be correcting. It was 14 and 15. And so we were underwriting really conservatively. And then also I had a couple of brokers tell me that they didn't trust that we could close. So after doing it for about 2 years and getting no results, I created a partnership, and I brought in a guy who had been a developer for roughly 20 years at that point. And we found some land, which was in Kerrville, Texas, and we did a mixed use development. It was a 10,000 square feet retail space where we had 2 triple net tenants in the spot. And then we built 60 apartment units. And we've sold off the commercial side of it, but we still operate the 60 units of apartment buildings, and it's been a great asset. We were able to sell the commercial side in 16 months for 41% IRR. And on the apartment side, we refinanced, returned all the capital to the investors, and it's just been a cash cow since the refinance ended.
Why don't you talk to us a little bit about the structure of your deals, Sam?
They vary from deal to deal, but most of the deals we do are syndications, and the majority of them now are 70-30 with a pref.
Sorry to interject here, but just want to make sure listeners who might not understand what that term is, it's a preferred return, correct?
Yes, correct. And I'm sorry. It's a preferred return, which means that if you invest, say, $100,000 and it's an 8% preferred return, you'll get 8% on your money return before the general partner will see any percentage or any cash back. And then once you hit that 8% preferred return, then the deal will split to 70-30 or 80-20 or whatever the split might be. And we obviously go through an attorney and register the deal with the SEC. So we're creating a security for all of our investors. And we go by the book and just make sure everything's done from a legal perspective, because your reputation is everything in this industry. And we want to give our investors utmost confidence to know that we're going by the book. And if something were to happen with their money, that, or even to us, we have a contingency plan. We have operating agreements that outline a lot of different things. I mean, like for the construction projects we've done, we'll get life insurance policy on the developer, essentially like key man insurance. So if something were to happen to them, the project won't stop. And there's a lot of things we take into account to make sure the investor money's protected, because that's the last thing we want to do is have an investor lose a dime or just have that sense that a project's in limbo.
Talk to me a little bit about the back end of those syndications, because folks who are not involved in syndication don't understand how complicated it is. I mean, how many investors do you typically have in a deal? Somewhere between 3 to 30?
Yeah, that's probably a good number. I would say probably 20 to 35 on average.
Okay. And so you got to communicate with them, and there's rules and regulations in terms of how, what, when, where, why you're communicating with them. Are you using somebody or an organization for the back end to help you manage that administrative process?
We use a software tool. They don't really manage the back end. And we do all the accounting and finance, and we send out monthly emails, but we have an investor portal where an investor can log in. They can see their performance over time. They can get their tax documents and just a few other items we'll send out and put in the investor portal. But I also think the investor portal, it helps legitimize you as a business, because some of them will look like a Charles Schwab or TD Ameritrade or something, where an investor can log in and they see their portfolio on a daily basis. The value doesn't change like it might in the stock market, but they can go there 24/7, 365 days a year just to see what their portfolio or how their portfolio is doing.
And, these syndicated deals can be great. And then at times, one investor who can be problematic can ruin it for everybody. How do you deal with that? Do you engage in bad boy clauses, like carve outs, if somebody's really causing some issues for the group that you can buy them out? Or tell us about that. Like, is that something that you have inside of your business plan or not?
We don't have anything inside the business plan where we have forced somebody out. Luckily, all the investors that I've dealt with I've had a prior relationship with them, and I've known them on some level. We've only had one investor sell their interest before we sold the deal, and that was for personal reasons that he was dealing with. But there are options where if they need to sell, they can sell at a fair market value. But we can either help facilitate that, or if they know a person who wants to buy their securities, they can sell it to them directly.
Gotcha.
So which areas have you been focusing in now? I mean, I know you started in Texas, and tell us how you've expanded your geographic reach.
Yes. Since I'm in Dallas, Texas initially made sense. But over the last 3 to 4 years, I've been focusing primarily on the Southeast, and specifically Atlanta, Florida, and North Carolina. I feel like there's so many great metrics that are happening in the Southeast and in those markets that it wouldn't make sense for us not to. And I feel like you have to have a great property management team in place. And we have a couple property managers that are in those markets, and we can rely and trust on them to be our boots on the ground. And then I'll go out, or somebody on the team will go out, depend on where we are in the project life cycle, every couple weeks, every month, just to make sure the projects are running smoothly. But I feel like those markets, like Texas, has rent growth, population growth, some great metrics on where rents are going, income growth. But one of the reasons I started focusing on those areas instead of Texas is the insurance and property taxes in Texas have just increased astronomically compared to other states. And it's really hurt your operating expenses, which obviously the lower your expenses are, the higher the net operating income is going to be, and the higher the valuation is going to be. And we haven't seen property insurance rates increase in the other states we're in like we have in Texas. So that's one of the key determinants that's made us shift our focus more to the Southeast.
Talk to us a little bit about Florida. I know you like Florida, so why don't you talk about, you own a property, I believe, just north of Orlando. Is that accurate?
Yes, we own a property in Sanford, Florida.
Okay, and so why don't you talk to us a little bit about Sanford, about the surrounding Orlando market, and maybe other markets inside of Florida that you target?
Yeah, and what you liked about Sanford when you went in there?
I guess taking it from a macro standpoint, we were looking in Jacksonville, Orlando, Tampa, St. Pete area. I never really focused on South Florida and Miami. At that time, I felt like the cap rates were too low, so I stayed in other areas. And it seems like I kept going back to Orlando, and I still look in Jacksonville and St. Pete, Tampa area. But Orlando, when I first started researching it, I thought it was just kind of the Mickey Mouse, and it was very much
literally, not figuratively. I say Mickey Mouse, it's usually referring to Steven's stuff that he works on, but no, this is like real Mickey Mouse, the literal Mickey Mouse.
Yeah. I was thinking it'd be basically heavily dependent on tourism, and that's just not the case. And with their university systems and then the population growth, there's really a strong workforce, and a workforce that's the gray/white collar, that have good stable jobs that are able to pay rent. And it's like I was saying earlier, the rent growth and job growth are important metrics that we look at, and depending on what, I guess, websites and publications you're getting your research from, shows a little different things. But like, I know Orlando is one of the fastest growing cities in the country, really since 2000, and population growth since 2000, I think it's doubled 45%, if I remember correctly, since from some of the research I've done. Yeah. And it's just a good, stable economy. It's fared well through COVID. Like, I was looking at a CBR research report, and year over year, I focus primarily on Sanford since we have the asset there, but Sanford rents are up 15.5%, And pretty much the whole entire Orlando MSA was in between that 10 to 15% range. One of the things I don't like about it, and this is just kind of across the board, since it is such a strong market, there's a lot of competition and it's really hard to get deals. But I think that's throughout the entire Southeast, Texas, Arizona, Nevada, you're going to have a lot of competition. So you have to be able to either preempt deals, go directly to the seller, or just have great broker relationships where they'll bring you off-market deals.
And so how do you find your deals? Are you using broker relationships? Are you sending out letters? I mean,
we haven't sent out letters yet, and I think that will be maybe the next iteration that we bring into the business, but it's all been through broker relationships. Luckily, 3 out of the last 4 deals, we haven't really had much competition. One deal was a true off-market deal. One was only showed to us and a few other groups. And then the Orlando deal or Sanford deal, they were starting to market it and we were able to preempt the offer. So we were able to buy it directly from the seller before they went through the marketing process. And I truly think if they would have went through the entire marketing process, the price tag would have probably been $1 million or $1.5 million higher than what we paid for it. So it is important to have the brokers. And one thing is, I think what helped us build credibility was that with that broker is a property management company we have has known that broker. They've been in business for roughly 40 years, and they were able to vouch from experience with us to help us get the deal.
So let's talk the flip side of that. When you're talking about finding properties off market, what do you do when you come to sell a property? Do you go off market too, or do you try and go through brokerage, or how do you get the best value?
At this point in the market cycle, I think you should always go through a broker and sell your properties and create that competition that taking it to market brings. I know in a lot of the deals we've put offers in on, or we get to the best and final, it's truly not a best and final. And there's 8, 10. I mean, some of the best and finals we've been in, there's 20, 22 investors. So if you can create that much competition, you're going to be driving the price, and the seller is going to benefit from it. So unless there's something completely wrong with the asset, or you get just a off-market offer that surpasses the purchase price or what you think the price is going to be significantly, I would always take it to a broker.
Talk to us a little bit about your investors. You say that you have a relationship with them. Is this sort of connections you had in a previous life? This is familial connections, or are these just people that you've been networking with? And if so, how are you finding them?
It's been really people that I've had connections with from business. And then the last, really since 2008 and moving to Dallas, I've been to networking events almost nightly. So it's a lot of connections I've met through just networking. And then over the years, I've had some really great partners that have helped bring in some of their investors. And now that we've been around for 5+ years, we've gotten referrals from quite a few of our investors and they introduce us to their connections, and it's grown that way. At this point, I've never really had to market or advertise, but I think that I've just started doing that because I do want to grow my investor base. I do want to be able to help more people invest in an asset class other than a 401k or mutual fund or ETF. And there's definitely a place for that in people's portfolios, but I think you also need real estate, and you can buy a REIT. But I think doing a syndication or owning a single family property or one multifamily property, the returns could be a lot better than it is in a REIT. And there's just some guidelines that we don't have to follow that the REITs do.
It sounds like when I hear you say things like IRAs and 401ks, that you're going to be targeting a less affluent, like non-accredited investors too. Is that true? And if so, then how would you go about doing that?
We've done both 506B and 506C offerings. And for your investors that are listening, a 506B, you can accept non-accredited investors, but a 506C, you have to accept only accredited investors. And there's some different rules around that. But I would say the majority of our investors are accredited, but there's a handful that aren't accredited that I've met through networking, or a couple family members, they aren't accredited and they've invested. So I just want to, we don't go after the hedge funds or institutional investors, but the high net worth individuals that want to get into real estate. I feel like over the last 10 years with maybe HGTV, with technology, with crowdfunding, syndications have blown up. And a lot of people now want to invest in real estate where probably 10, 15 years ago, that wasn't even an option. And I think social media has been great, and podcasts like yours to get out the word and show people that there's other alternatives to just investing in the stock market. And if I can help people achieve their goals and dreams through another vehicle outside of the stock market, that's one of the passions I feel like that I want to help them achieve that goal and live their desired life.
So tell us what you're looking for, like what in a deal, like what's your strategy?
There always has to be, and it kind of changes from deal to deal, but we always have to go in and to add value to it. And this part of the market cycle, especially in some areas over others, some of these deals have been renovated 2, 3, 4 times. So it can be more difficult, but we'll see if there's operational inefficiencies that we can take advantage of. If property management, the current owner is poor, or if they self-manage, sometimes they don't do that great of a job. If they're below market, if we can go in and renovate units to a higher standard or better standard, how much can we push rents compared to comparables? There's a lot of different things we look at. The majority of my portfolio are newer assets. So sometimes it might be a first time renovation, or just going in and changing up some management inefficiencies. Like we bought one property in Mississippi actually, and it was owned by a hotel operator, and they were operating it like a hotel in terms of they were paying everything for the tenant utility wise. Like they even paid for their cable, they paid electricity, water, gas, everything. So that was easy to just bill back and rub back all the utilities to the tenants that they deservedly should pay. And in the meantime, the rents over a 2-year period, we've increased the rents over $300. And there's a few other areas that we look at. And even on this property in Sanford, it was built in 2017. And the developer, for some reason, they built it more like a B-class property. So the owner we bought it from had started the renovation process of putting in stainless steel appliances, quartz counters, and we've just continued to carry that forward to bring it up to a standard that an A-class tenant would expect. And then we've been able to change a few things that the previous owner did that our current property management company is doing that will just increase the value that much more in the property, and hopefully we can optimize and run it more effectively than they can.
That's awesome. So, Sam, if people want to reach you to find out more or maybe hook up with a deal, what's the best way they can reach you?
You can reach me on pretty much all social media, or my website is batescapitalgroup.com, and it has all my contact information there.
And before we let you go, just one final thought, whether it be about the state of Florida or investors that are considering making the move out of buying individually into syndications, or any other real estate tip. What would you say to them, Sam? What would be the first thing that comes to mind?
I'll focus specifically in Florida, but it can be in any market. That if you're thinking about investing and you want to invest, I would say do it today. I feel like the market, even though it's very competitive, it still is a great way to invest your assets, and prices have only went up over the last 10 to 15 years. And with the shortage in housing, with the shortage in apartments, with people moving to the Sun Belt and to Florida, values are only going to go up. And everybody's worried about cap rate decompression. And there might be some legitimacy to that, but I do think cap rates are going to stay low. I think with inflation, if it hasn't hit, it will hit, that it's better to have your money in hard assets than other assets. So I think it's a great place to invest.
Awesome. Sam, really appreciate the time that you invested with us today and the success you've had. I mean, it's definitely, you've done a lot, and being spread across the entire Southeast the way you are, it's a tall order, and you seem to be doing a great job of that. Stephen, anything else before we let Sam go?
Sam, thank you. And we wish you continued success and look forward to hearing more great things.
Well, thank you, Eric and Stephen, for letting me share a little bit of my story on your podcast. And I wish you all the success in the podcast and any endeavor that you do.
And that was Sam Bates from Bates Capital Group. Stephen, what were your thoughts?
Part of being successful is keep it simple. And I was listening to what Sam said he looked for in certain markets, and it's the same thing that many investors look at, and it's rent growth and job growth, and just find those areas where you can have those opportunities and keep it simple and don't overthink it.
Yeah, Sam was a great guest, Stephen. And if people want to listen to other real estate topics, where would they go to find those?
Well, the one place to go is you can go to our website, www.investfloridashow.com. Also, download the app and listen to it on your mobile device. You can listen while you're on the road or commuting or in the gym.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.